I'm Matt Bouchard with REITWeek.com here in New York City for REITWeek 2016, NAREIT's Investor Forum. Joining me today is Dave Hegarty, President and Chief Operating Officer with Senior Housing Properties Trust. Dave, thanks so much for joining us today.
Thanks, Matt. Thanks for the invitation.
Now, how would you describe the current market dynamics in the senior living and medical office building sectors?
First, I just want to point out that we're about 55% senior housing and 45% medical office buildings. So it's almost half and half. And in the senior living industry, right now we're going through an interesting time. There's a lot of concerns about oversupply. I do think that that's exaggerated. I believe it's a local business at the end of the day, so it depends on particular markets around the country, and some are thriving and some are experiencing a little bit of oversupply, but I think it's overblown. On the medical office side of the business, it's a very good time. The dynamics of the industry and the healthcare systems are becoming more and more outpatient focused. Accountable care organizations are making the system more efficient, and then the healthcare systems are trying to bring the services out to people in the suburbs and surrounding areas to capture a wider base of population. So it's a very good time for the medical office building area industry. As I say, our focus really is trying to capture that baby boomer generation that's turning 65 at this time, pretty much on that 10,000 person a day record. So that's the great wave coming on, and we'll capture them on the back end when they turn 80, 85 and fill up our senior living communities.
And what is the extent of opportunities for internal growth across your portfolio?
You know, our portfolio has a modest amount of the RIDEA type assets where you get the benefit of the bottom line. It's about 15% of our bottom line. And everything else, for the most part, is triple net or multi-tenanted or single-tenanted medical office buildings. And within that, you obviously have different ranges of growth potential, and we believe that still the RIDEA assets have a good 3 to 5% growth potential just from industry dynamics. And then the other areas, we look for opportunities to raise rents at the MOBs. 2% or so is probably normal, and 1 to 2% on the triple net senior living component.
And how do you see the balance for the near term between acquisitions and dispositions shaking out?
Well, this is going to be a very modest year, I believe. I believe pricing is very expensive right now to be buying product, and there's a significant amount of private equity capital chasing the product, so we're best to remain on the sidelines, look for internal opportunities. We've only acquired, I think, about $75 million of properties this year to date, and I don't see it being that much more for the rest of the year, or maybe a bit more. But and then on the disposition side, we will be disposing of assets along the way, and maybe that's going to be half as much of dispositions, but it'll be very modest.
Great. Dave, thank you so much for joining us.
You're very welcome. Thank you.
For more from REITweek 2016, be sure to visit REIT.com.